Hello and welcome back to the Note. It's time for scenario analysis. This weekend, Greeks go to the polls to vote yes or no, ne or ochi, in a referendum. Europe's leaders are trying to convince them that they will be voting yes or no to staying in the euro. Their own national leaders are trying to say that they aren't, and confusion reigns. But it's clear that the dreaded Grexit, Greek exit from the eurozone in a disorderly fashion, that's closer than ever before. Now, as far as investors are concerned, trying to predict the result of this referendum, I would say, is futile. Just think how badly the pollsters went wrong in this year's British election for a start, or perhaps even more pertinently, think of the 1992 referendum, when Denmark stunned everyone else by rejecting the Maastricht Treaty. Instead, I would suggest we need to go for scenario analysis. What happens if we get a no, and what happens if we get a yes? Let's start with a yes. That's plainly the best scenario in the short run for markets, even if it does intensify the political turmoil in Greece.
But if they were effectively to cave in, I think from the point of view of the markets, that would be seen as the least bad outcome. I think volatility might subside and we'd actually see quite a noticeable near-term bounce in stock markets. Should clients try to play that, it's very difficult to call. That's why we're trying to take a long-term view, simply emphasizing the importance of getting your long-term positions in place and sitting tight. Even in a worst-case scenario, as the markets might see it, we think that the global capital markets can muddle through.
Now, while I agree that that's the most likely scenario, bear in mind that it's still not smooth. Who will be able to negotiate on behalf of Greece at that point, for a start? You'd have to assume that the Greek banks stayed closed for quite a while longer, and that would inflict that much more economic damage on Greece. Now, what about a no vote?
I think the worst scenario would be a Grexit, in which there are liabilities out there that we haven't seen recorded clearly, and one or other important private sector institution turns out to have a little bit more at risk in Greece than we'd imagined, in which case we could be anticipating the sort of volatility, I would hope on a smaller scale, but the sort of volatility that we saw back in 2008.
In other words, that is effectively the mini Lehman outcome, a rerun of the horrors of 2008, even if not quite so bad. It does, however, seem much less likely than it did. Now, why is that? First, as this chart shows, banks have used the time bought for them by all that desperate summitry over the 5 years now to get rid of their exposure to Greek banks. If Greece had defaulted and Grexited back in 2010, when it received its first bailout, that probably would have brought down the European financial system. Now, not so much. Second, the European Central Bank has at last thrown money at the problem. Now, in the early years of the crisis, they famously refused to do that. They even raised rates in what proved to be a wildly premature move. But now they're buying bonds, as you can see from their expanding balance sheet. If you want proof the markets have convinced themselves it wouldn't be so bad, just look at what's happened to Spanish bond spreads. This is a bet not only that Grexit won't happen, but that if it does, it won't matter that much. It won't have an effect on Spain. Meanwhile, even Greek spreads are far lower than they were in 2012. Can that be right? Are the markets really correct that we could handle a Grexit? Now, opinions differ.
If a country that leaves is a country that shouldn't have joined to begin with, sadly the credibility of the euro ex that country may actually go up. And at the back of some traders' minds, that might be one of the reasons why the euro has been trading relatively resiliently through this whole affair.
And if we have a no vote, the European leaders have made it perfectly clear that they see that as being a vote by the Greek populace on whether they're going to want to remain within the euro or not. So one possible outcome of this is that we could be potentially heading towards a Grexit. And that matters a great deal because that changes potentially the very nature of what the euro is. We have been under the impression to date, because that's exactly what the treaty says, that this is, once you become a member, it's irrevocable. If Greece can leave, who knows at what point in the future somebody may also have to leave. It may be a small nation, it may be a larger nation. But the fact that that is there means that investors have to start factoring in, even if only in the smallest way, the possibility of an exit.
So we do have to ask ourselves if the market has underestimated the impact, because after all, this is an unprecedented event. If Greece does come out of the euro, or if the Greek central bank is forced to print a new currency just so that people can carry on with their transactions in the force of capital controls, well, maybe we do have the situation where there's more of a question mark over the whole coherence of EMU. If that happens, well, yes, I think there would be more capital flight from the Eurozone.
If it's a no, then the focus must immediately turn to the Eurozone institutions. By cutting off support to the Greek banks, they could force Greece out. Are they really confident enough to do that? And if it's a yes, what happens next in Greece? Presumably Europe rewards the Greeks for voting yes, but who inks a deal? The two scenarios are actually less different than they appear.
Actually, the outcome for the euro in terms of direction is probably almost exactly the same for either outcome. If we go towards a yes vote, and certainly the polls that we've seen in recent days suggest that that is the case, then beyond whatever might happen politically within Europe or within Greece, it would seem to me that the risk appetite to investors will start to grow again, because beyond what's happening in Greece and maybe a few ructions in markets in China, for example, to a large degree we seem to be in a relatively benign investment environment. If that's the case, then that's almost the ideal environment for the carry trade to come back. And of course the carry trade is always funded by an ultra cheap currency, and right now trying to find cheaper funding than the euro, unless you're looking at Switzerland or Denmark, is hard to find.
Finally, some of you might be wondering, what's the point? Market professionals can move money far faster than any retail investor, and the market can move in very sharp gaps. This is a binary result coming. By the time we know the result, it probably could be too late to act. To that, I'd say look at this. Whatever news we get this weekend, it won't be as bad as the news the weekend in September 2008 when Lehman Brothers went bust, the most shocking event in modern financial history. And yet, as you can see, US stocks ended the first week after the Lehman bankruptcy higher than they had started it. You still had a chance to avoid a 44% loss that ensued. So take these as the bottom lines. Big events like this always create confusion, noise, and opportunities to make or lose money. Don't go in with an extreme weighting to anything, and even if you do need to move swiftly, don't try to move everything at once. Whatever happens, the euro is likely to weaken. And whatever happens, European stocks are not terribly expensive. A big sell-off could create very attractive long-run entry points for those of you who can take the currency risk. And if it really does come to a Grexit, remain sceptical that we can really take it in stride. And the most likely outcome is another messy muddle-through. That may or may not be best for the luckless and unfortunate Greek people, or indeed for the rest of Europe. But it's the result that the markets are closest to pricing in.